when I first heard about Bitcoin when it was $74, and I should have bought more, right? Yeah. Okay. I loved the idea. I mean, I want to see it succeed more than anybody you can imagine, because I love the idea of a currency of the people, that's not controlled by a central bank. There's just way too much evil doing going on with central bankers and governments all around the world, right? But it just puzzles me because, you listen to every Bitcoin maximalist and they're just so high on it. And, if you listen to a couple of Michael Saylor videos, you might put your life savings into it. Right? But then,
a lot of people have.
See, here's where the money meets the road. I always say this. If the lenders won't finance it, that's the true believer. That's how much faith they have in the deal, right? And in your case, and in many other cases, nobody will finance it for more than 50%. I mean, that's where the rubber meets the road. If they think it's so great, why don't they give you 90% LTV on it like they will on a house, right?
Yeah. I mean, it really comes down to volatility, right? The mark to market, right? So if you think about it from a lender's perspective, right? If I charge 10% interest, that's all I'm going to make, right? Where if you think about from the consumer's perspective, the reason why they're doing this is that they believe that the value of the Bitcoin is going to continue to appreciate. So they have all of the upside.
Yeah.
And that element of the downside, right? So in our case, right, we would say, we'd love to be able to finance at higher levels. I think you did have lenders in the past that did finance at higher levels and even under collateralized. And I think those are the individuals that unfortunately in those volatile swings lost a tremendous amount of money, right, doing it that way. So I think it really comes down to the asset class. And if you look at something synonymous to stock lending and margin lending and what has existed in the sort of traditional,
it's pretty much exactly world, like that.
It's the same thing, right? No one's going to finance 100% of it, right? They'll give you 60 cents on the dollar, 70 cents on the dollar, depending on the volatility. Right. But you're not in a position if you don't have any other line of defense, right? And recourse.
Got it. I understand it from the lender's perspective, and you always want to understand every deal from both counterparties. Right. That's definitely the thing to do. But the lender, unless they just are desperate for liquidity, they don't need to sell that Bitcoin right away. Take, for example, a bank, right? A bank takes back a property as an REO, real estate owned, right? In foreclosure. They're not like forced to sell it right away, right? You could wait till the Bitcoin goes back up.
They're not. But real estate isn't mark to market either through the loan.
Fair enough. Yeah.
Right. From our perspective, right, we're long-term believers in Bitcoin, right? We believe we're helping people be able to finance things that they want to purchase today, but ultimately keep their Bitcoin. And it's their decision when they want to sell, right? And if that means they want to pay off the loan, then that's a way of doing it. We've definitely had clients that have seen the appreciation of the Bitcoin and they turn around with some of those proceeds and pay us right back. But it's on their terms, right?
Yeah, absolutely. Okay, so we're going to move to the real estate product here, which is really your core thing in just a moment. But, we all heard that phrase so much during the Great Recession back in 2007, 2008. And the phrase was mark to market. Okay. And so is that mark to market required of you as a lender, where that's putting pressure on you as a lender that if you take those assets back, you got to sell them right away? You can't just hold them and hodl like any Bitcoin investor would, right?
Yeah. I mean, I think there is that possibility, right? It just depends sort of what your capital basis is, right? And what type of risk you want to take, right? And in our case, right, we're taking borrower risk, their ability to pay, and, we are lending at higher loan amounts than perhaps a conventional, mortgage would entail, at least, in today's day and age. So we need additional collateral for that. As a company, we do hold Bitcoin, right? We do own Bitcoin, but we are also very, very clear that the Bitcoin that we hold, that is our clients, is a liability to us, right? It is their asset.
Like a bank. Yeah, sure. Correct. Understood. Right. Because you have to give it back at the end of the loan.
Correct.
Right? But the loans are an asset to you, just like a bank.
They are an asset. Absolutely. They're an asset, right? And I think that element of being able to combine, real estate collateral, which more or less what it's worth, with the combination of Bitcoin, right, creates a very interesting profile, right? Combined profile.
Okay. So the main product that you offer that we really want to talk about today is 100% financing on real estate. So what that requires, and just correct me if I'm wrong on any of this stuff, but I want to just outline it for the listeners, is take, for example, you want to buy a $1 million property. You need $1 million worth of Bitcoin or Ethereum and $1 million property. Yep. And they will both be liened, and you'll finance 100% of that deal. but you need $2 million in collateral. Normally just the property is the collateral for the lender. And they might loan you, 90% if you're owner occupied, 80% if you're non-owner occupied. So you'll get an $800,000 loan and you'll only have $200,000 in the deal. In your example, you need to have $1 million in the deal. Fair?
Well, they have $1 million of collateral from a Bitcoin perspective, but they still continue to own it.
Right.
As an asset, right?
As long as they pay the loan. Yeah.
Correct. Exactly. So in a traditional deal, right, you're going to have someone that has contributed 20 or 30% down, right? So they've got that element.
Or 10%.
Or 10%.
Or 3.5% if it's FHA,
Correct.
I mean, FHA, think about it, folks. In some cities, FHA loan limits are above $1 million. FHA is not for the poor. Okay. I mean, $1 million still buys you a decent home. Okay. In most places. Yeah.
But then you also see where the greatest amount of severity is, where people are not able to pay for their mortgages, right? It tends to be in those very same mortgages, right?
Right. Yeah. Okay. Got it. So we come to this transaction with $2 million worth of collateral, $1 million property, $1 million in Bitcoin or Ethereum, and we can finance 100% without selling the crypto assets. Okay. So we get to keep that and the future appreciation, hopefully, if it happens, on that. Does that have on that $1 million of crypto? Now, this is a real estate deal now. It's not like we talked before just about strictly crypto financing. Is there a margin call element in that one as well?
There is, if it goes down. But the amount that it could go down is significantly greater because now we also do have the real estate, which allows us to basically give them more room where that collateral could drop well over 65% from that starting value, right? So that $1 million could go all the way down to $350,000, where then we would ask them to post more collateral.
Okay, so the margin call is never on the real estate, though, it sounds like.
Correct.
It's only on the crypto.
It's only on the crypto side, correct? Because you can't,
So if the real estate goes down in value, you're not going to say
real estate. Yeah, you couldn't do a partial liquidation of real estate.
What does that mean?
So we couldn't sell a portion of the home to someone else.
Right. Okay, that's what I thought you meant. Yeah. Okay, so if the house goes, say there's a terrible real estate crash and the house goes to 700,000.
Yeah.
But the cryptocurrency is still at $1 million. No margin call,
fine.
Right?
We're still fine. No.
Okay. But if the cryptocurrency goes down by, 70% and now it's worth 300,000 instead of $1 million.
Correct.
We've got a margin call.
Yeah. There would be a request for additional collateral or reduce the loan balance, right? Which is an option.
Yeah. Okay. Either one. Okay. And these loans, in terms of the terms, they're similar to a Fannie Mae deal, except the rate is higher, right? They're a 30-year amortized loan.
They're 30-year, interest only. And then for the first 10 years, they're going to be interest only, and then they're going to amortize. And then after that, the rates are going to be a couple percent higher than a conventional rate of 7, right? We're going to be somewhere in the 9s. So the rate's going to be a little bit higher, but well within the limits of something that is more of like a hard money loan, right? Which is going to be somewhere in the 12s and 13s.
Right. So it's cheaper than a hard money loan. It's more expensive than a Fannie Mae loan for sure. It's more expensive than a DSCR loan even. It's around 9%. And when you say it's around that rate, it's because you do some underwriting on the credit and the other assets the borrower has, right?
Correct. We're going to look at that. Obviously, we lend across a lot of states across the U.S. There's different property types, right? There's different variables that come into that more dynamic rate pricing, right? That we look at, right, as variables.